So I'm actually going to change the topic a little bit. I was thinking about what I could do. I could spend 20 minutes boring you guys about what LendUp is, but you guys can go to our website and figure that out. So that seemed like not a great use of time. And then I thought, well, God, how do startups and banks work together? That might really be an interesting talk, since probably there's a decent amount of startups or venture. Actually, who in this room, works at a startup? Okay, a good amount. And who works at a bank? And who's an investor? And who is not in one of those categories? Okay, all right. Well, so I was thinking about like how startups and banks can work together. Maybe that would have been a good topic. But when I was looking at the agenda, what I thought might be an even more interesting topic is, why is this consumer lending and why is this fintech startup thing such a big deal, given that we're going to have a pretty incredible panel coming up right now with Lending Club and Funding Circle and Prosper and SoFi and Peter Renton moderating, which is pretty exciting. So I decided to talk a little bit about how big can fintech be. And we'll focus this one on consumer lending, since that's where I arguably have somewhat of a domain expertise, even though I might look like I'm 13. So just a little bit for those of you who I guess didn't hear the intro that I just had. I've a couple university degrees focused mostly on applied math and behavioral psychology. I've worked at big global banks, big government banks, pioneering nonprofit banks. I've worked at startups that have been acquired by other large institutions. And currently, I'm the co-founder and CEO of LendUp, hopefully my last job, because I love this company, so I want it to be huge. I just put some of our investors up there, so you can see, we're moderately good at convincing some smart people to foolishly give us their money, like Y Combinator and DST, Kleiner, SUSE, Google Ventures, Andreessen Horowitz, Data Collective, Victory Park. So, okay, this startup thing, is this actually a big deal? So this whole thing, I just was on the advisory, got invited to be a part of the advisory board of TransUnion, which is one of the 3 major credit bureaus here in the United States, as many people should probably know. And they gave a whole presentation about the future of what they're trying to build, but they also give a really good data analytics about the state of the industry. And this slide really stuck out to me, and I haven't been able to forget about it. And so I thought, let's base a whole talk on the premise of how interesting is this slide. So what this slide is the history of consumer lending originations. And what you can see if you look closely is banks in the history of the United States have always done the most consumer lending. They've always originated more loans than anybody else ever, always. Not anymore. This quarter is the first time in the history of the United States that private financial companies have originated more consumer loans than banks. Now that's a pretty remarkable thing if we think about a shift in the dynamics of how consumers are interacting with financial services, how they're getting access to different types of loans and liquidity. And what we're seeing is it's making a major shift right now. That's a really exciting thing, which you'll learn about as soon as I get off the stage and let you guys listen to slightly more interesting people. And so this is happening for a variety of reasons. I'm sure there are more, but as you can see from the lack of design, and sort of put this together pretty quickly on the things that I sort of fundamentally know. It's not quite as exciting as the data that just happened before this. But we're seeing since 2008 and with Dodd-Frank a drastic increase in regulation and with fines. And if you just put an alert out on CFPB with the Google alert, you'll probably see about every week some major bank just playing catch-up right now. Private companies, major companies, there's a lot more regulation that's happening. So what you have are these organizations that are already playing catch-up now with even increased more regulatory oversight. And so if you're a compliance or a lawyer in this room, you're probably sitting really pretty right now, because the shift has happened in a favor that has made compliance and lawyers probably just as coveted as developers in the valley across the financial services regulatory landscape. Well, we're also seeing that we're having this prolonged period of no market returns. So capital markets are looking and hungry for returns. All of a sudden, there are these private companies that are showing consistent, reliable returns and the ability to originate serious volume, billions of dollars. Well, we also are coming off of the lowest trust of banks. You can't really see that chart probably very well on the bottom right, but those dark blue lines are a ranking of some of the major trust organizations, and banks are not at the top. And if we look at the top right over here, we're also seeing Marc Andreessen's famous quote that software is eating the world. And this is true. Software has never been a competitive advantage for banks, and the dynamics has shifted so quickly between mobile and how customers interact digitally as opposed to on branches that software is now a competitive advantage. And it's hard for banks to build this as an expertise. There's not enough qualified developers in the US. The government hasn't caught up to let more international developers, software developers come and help build all the things that need to be built. And the core banking infrastructure is still based upon late 70s, early 80s mainframe technology, and trying to adapt that in a quickly iterating way in like a JSON API is incredibly complex. And it's coming there, and there's new startups that are coming forward, but it's still sitting on really old technology. So when we look then and we think about these major shifts that are happening and the time frame it's going to take banks to catch up, you can say, oh God, well, we already have OnDeck's already public, Lending Club's already public, they're marketplace lenders, we're done. No, I think we're far from done. And what we're seeing from this slide is we're just now scratching the surface. And even if we look at the impressive origination of these marketplace lenders, we're still at a fraction of the market today. And if we look back at the trend of the first graph, you can see that the overall trend of personal loans is going up, and the share of private companies are going up. That means there's opportunity in this room for people like you to start companies to attack even larger markets than we're even starting with today. So then we start thinking about, what's taken so long? We knew there was this regulation. We knew that there was shifts in software and consumers are losing trust and there's markets. But we've been distracted here in Silicon Valley with these shiny objects of social networking, like the Facebooks and Twitters and Instagrams of the world. Well, thankfully, they've all gone public or been acquired, and so we don't need to think quite as much about the next photo sharing app, as fun and as cool as those are. Real revenue-based startups are now finally back in vogue, which is exciting for probably most of the people in this room. Yay, like, let's create companies that actually generate revenue, and we know what we're going to do. Not that Facebook obviously doesn't generate a ton of revenue, but like known revenues for early stage, we can now finally get funding. We're starting to see venture capital returns from Lending Club and OnDeck coming back into Silicon Valley. That gets investors excited. That gets them investing in more companies. That hopefully gets them investing in more of you guys to create more innovation. So I ripped this slide from Foundation Capital. I hope nobody from Foundation is in the room. If they did, I asked permission from somebody else at your firm ahead of time. But basically, we shared this slide ahead. There is a whole huge variety of companies that are out here that are serving various categories, from consumer to small dollar to purchase finance. And there's a lot of companies already started, but there's still a lot of room left to go. So we get there, and this is more for those that raise their hand during the investor section, and are there risks to starting a financial services company? Yes, there are risks to all sorts of companies. In financial services, there are even more. And it's a constantly changing ecosystem, right? So we have examples of rulings that are in process, like Madden versus Midland, which can affect how startups and banks can work together. We have obviously a brand new, very aggressive regulatory body, in addition to all the ones that are existing out there. There's always new proposed rulings that are coming through. There's true lender risk specifically for the startups and banking relationships. The good news about all of these is these are pretty much solvable. They're solvable with more lawyers and more money. So this isn't like a surprise. Yes, there's risk. We just need to account for that. And so they take a little bit more capital up front. But there's still real revenue businesses that are growing. Are there credit risks? Here's another slide from TransUnion Deck. Yes, there are definitely credit risks when we're talking about credit businesses. And these are tried, untried, and untrue through the testing of time for consumer lending. But what we're seeing is there's been a lot of opportunity in the subprime. So if we look at banks, credit unions, and finance companies, on the right-hand side, you can see where the skews are in relation to the credit risk. So each band, the bright yellow one is the subprime, orange is near prime. So you can see that finance companies, meaning non-bank, non-credit union lenders, are taking on more risk. But they're also compensating for that by having their own software and lowering marketing and lowering operational costs, and using more data supplemented by better and newer software. So you can take most of the existing data that exists out there, the FICO scores, the major credit bureaus, and supplement them with more what they're called, I guess, alternative data, but more data to continue to supplement that. Now, I think we'll see the test of time how this holds up, but what we're seeing is very consistent returns despite taking higher and higher risk. I think the interesting and the more concerning thing with marketplace lending today isn't whether or not the industry will be bigger. Yes, whether or not the industry will continue to survive. It's that we're seeing now that with marketplace lending becoming a little bit more of a mature industry, and the primary purpose of these loans is refinancing out other debt, that what we're seeing is customers are now going to over 50% of all marketplace lending originations are existing customers. So what we're seeing is existing customers taking out loans and loans. They're paying off their credit card debt or their other personal lines. And then we're starting to see these other lines starting to build up. So we'll see how that comes out at the end of the day, in not just in the underwriting at a point in time in an origination for a marketplace lender, but how that really affects the ecosystem as consumers are starting to see their total debt burden go up a little higher. So with all this, does this mean we should stop creating new companies? We should stop inventing and investing? No! Don't we remember this slide? Oh, I was 2 steps ahead. God, blew it. Anyway, this slide, banks are not coming to be catching up anytime soon. Sorry, John. I know Wells Fargo is a great bank, but they're still sitting on this core infrastructure that's old, and they're sitting on playing regulatory catch-up just like all the rest of the banks. That means there's huge opportunity, and if we go back 1 slide now, financial services is the largest and most liquid industry in the world. It's almost 8% of US GDP. We're talking about over $1 trillion of opportunity for everybody in this room and outside. So when we look at all of these verticals and we take the foundation capital, there's so much opportunity out there that I want to make sure that we're always thinking about, what else could we be doing to the ecosystem? What else could we be creating? There's consumer lending, payments, collections, insurance, automating compliance, modeling, debit. If we just take one of these examples in the consumer lending, let's look at all of the different exciting part of the ecosystem. We have Avant, Green Sky, Lending Club, Prosper, Lending Home, LendUp, SoFi, BuildCard, Opportune, across all sorts of verticals. And these are not winner-take-all markets. As much as we would love to believe as the CEOs and co-founders, there isn't one bank. There's very rarely an open country where one bank exists, or there's so much opportunity within each of these. And then aside from all of these different companies that are growing up, maturing, creating value to consumers and to investors, there's a whole ecosystem that services these. So where would all of these companies exist without other companies that are handling messaging and emails and compliance, website development, scoring, marketing, fraud, payments, mail? So there's so much opportunity as we think about this growing ecosystem and how these are shifting to create conglomerates of these APIs to build value. There's so much opportunity for new startups to service this ecosystem as well as lead this ecosystem. Let's see. So I tried to sort of put this up into a little bit of a takeaway. Hopefully it's a little bit inspiring. We can go for any questions. I think disruption is just getting started. The ecosystem, we're not even scratching the surface in basis points of the total market. That means there's more opportunity. And we're just now starting to really see venture capitalists getting returns on their investment, which just makes this ecosystem even more and more exciting. Yes, there's different risks, but those risks are mitigated. That's what lawyers are for. And lawyers are just money, effectively, right? We're buying time and expertise. If you can't afford to bring them in-house, there are ways to think about how to incorporate compliance and regulatory expertise early into the ecosystem. Public markets will value different companies differently. I was just talking about this with Peter in the back room, who's going to be moderating the next panel, about thinking about, for lending, are you a direct lender, are you a marketplace lender, are you a hybrid? And even over time, we see that the valuations and the multiples will adjust, but this is not an industry that's going away, and it's not an industry that isn't going to generate a ton of revenue. Times are shifting pretty rapidly. Mobile is now sort of the leading edge of how customers want to interact. So banks that have incumbent branches and brick and mortar stores are trying to face this transition in. And if you can start from scratch, that's an incredible opportunity. Mobile regulatory at the front is changing rapidly. If you can start with a clean slate and you have better intentions of creating different types of value, that helps. And it gives you a little bit more of a proactive approach. And just technology, how consumers are interacting and facing with each other. There's very few banks that even talk in JSON. I think if they're upgraded to a SOAP API, that's incredibly exciting for them, which is, I don't know how many years ago of technology. And yes, you can do it and you can write it. It's just super confusing. But it's coming. So building these ecosystems and pulling in the best of all of the rest of the companies that maybe some of you have started or maybe are outside of this room can pull together, find a market opportunity, and prove that you have product market fit. Venture capital should flow pretty quickly. So I think there's a lot more opportunity out there. There's a lot more investing to happen. There's a lot more building. There's a lot more opportunity. And if you have any shortage of ideas, let me know, because I can name a ton of things I don't want to work on that I think are venturable backed ideas around. If anybody has any questions or ever wants to follow up with me, Sasha at LendUp.com. I'm pretty easy to get a hold of. Yeah, that's about it.